welcome back. At the top of the hour, we were talking about the experience versus quality, and Russell Wilson winning the Seattle quarterback job, even though he has very little NFL experience. But obviously, he did show the quality that people look for in a quarterback. And, when it comes to quality in real estate, certainly you do have a lot of other things to think about. But one of them is when you start getting your financing. And Ryan and I were talking about this before the break, about, the pre-approval letter, people going out, they're out looking to buy a house. And, is the pre-approval letter even worth the paper that it's written on sometimes? There's a lot of lenders out there who they throw them around like it's no big deal. And with rising interest rates, you do end up at a position where sometimes the rising interest rates can make that pre-approval letter basically invalid because now they've been priced out of the homes that they want. So Ryan Leopold here is back with us with Cobalt Mortgage. And so, Ryan, we were going to bring up a few strategies for people because, you start looking at quality versus maybe experience. And a lot of people maybe, go to a lender who has experience. But maybe they don't do that quality job that's so needed right now in the lending industry because we have, a hot market and rates that are going up and down.
I think to kind of play on that same theme, that pre-approval, is crucial, and that lenders are still sending out pre-approval letters without collecting a full file. So that is crucial. And then in a rising interest rate, which, we've seen rates go up maybe 0.25% over the last 2 or 3 weeks, but we just don't know where rates are going to be in the next 4 to 6 months. They're going to be relatively low for the next year or two, but what does that really mean? Does it mean 3.5 or 4.5? So when that happens and you have such a competitive market for buyers, they have to always be re-engaging with their lender to make sure that that pre-approval is accurate, because so many things can change, not let alone their personal financial position when it comes to job or credit or assets. But the second piece is just really interest rates and what people qualify for.
So let's get into that because obviously you and I don't control interest rates. People are subject to the interest rates typically that are offered. And it's very difficult to time a market just like a stock market. You can't just time the up and you can't time the bottom. So what are some strategies as rates tick up, because they have over the last 4 or 6 weeks, what are some strategies that people can use in order to essentially still buy the house at the same price, even with higher interest rates?
And I think there's 2 different ways to look at that. I think one, you can look at it from a standpoint of, I was pre-approved at this, interest rates went up a little bit, and either A, I still need to be pre-approved to buy that house, even though the cost of that money is going to be a little bit more expensive, or B, the minute when you meet with somebody and you talk about strategies in general to basically, what is the most strategic way to finance a home, specifically when someone doesn't have that traditional 20% as a down payment. So if someone's putting 5 to 10% down, they're going to have mortgage insurance in some capacity. Okay. So mortgage insurance is going to be represented in 1 of 3 different ways. They're going to have monthly mortgage insurance with just a monthly premium. You can actually finance in mortgage insurance to the loan amount. So now you're maybe financing in $4,000 to $6,000 into the loan, but you're not going to have monthly mortgage insurance. Or you can actually pay mortgage insurance out of pocket in cash. So that can either be, a little bit more money out of savings, or being a little bit more strategic and have the seller cover mortgage insurance by raising the purchase price just a little bit.
And so, there's all these different ways and that all kind of makes the payment the same because you're paying for your mortgage insurance in a different way.
I don't think it necessarily is going to make that end payment the same, but one way or another, you're paying for the mortgage insurance. So when you talk about these 3 different strategies, it's not necessarily which one is best. It's understanding what people's objectives are with the home. So maybe it's just comes down to trying to qualify for a little bit more home, but payment is a very sensitive topic. So if you say, gosh, I'm borrowing money at 3.5 to 4%, and I can finance mortgage insurance into that loan amount, in essence, that's going to possibly cut off $200 or $300 out of your payment each month. So that's a big deal. And that's a way, if rates go up a little bit, to minimize the pain that someone feels by having a higher rate and a higher payment that could, maybe affect their approval one way or another. So each one of those options, there's no right or wrong to the 3 mortgage insurance strategies. It's just a different way to look at it. And everybody's situation is going to be different. And it's something that I think that most lenders don't get into a lot of detail with their buyers on, because it's kind of something that isn't really talked about as much as it should.
But so, I mean, what ultimately I think I hear you saying is when rates go up, there are strategies with mortgage insurance to still get approved for the same price, even with a higher interest rate.
Absolutely. Yeah, by just being a little more creative with the mortgage insurance, for example, or even in some cases, you can get creative as far as...
And let's not, you say creative. It's not really creative. Isn't it more
strategic?
But understanding how there are maybe 4 or 5 options to get mortgage insurance where most people probably think there's only one.
Absolutely.
I mean,
Absolutely.
it's not so creative like, okay, well, when I hear creative, I think of lenders, 5 years ago going, well, we're going to get creative so we can get that out. Strategic, I mean, just knowing the products and what's available.
And I think that's where a lot of lenders do fall short. And you say that what you talked about at the beginning is that experience and that professionalism of knowing, what options are available for buyers, to be proactive in educating buyers on what their options are and working with them to help them make the best financial decision when it comes to, financing their home. And that's just one factor that goes into it. So if rates go up and someone really wants to buy this $400,000 house, but now they can't quite afford it, you do have to be strategic in some ways. And mortgage insurance is one tool to be strategic to help someone achieve their objective. Not put them in a bad financial position by any means, just be a little bit more, strategic based on their situation. I mean, there's other things you can do. Pay off high interest, take a little bit of that down payment, that money that would have gone to a down payment, pay off high interest credit cards, because maybe you pay off a credit card or a car that's at 10 to 15%. Now their liabilities are less, and use some of that down payment money for that. So that's another way to just look at people's financial position differently to help them get to that end result in a better way. Because
it is scary for a home buyer when interest rates go up. I mean, that's a scary thought, especially first-time home buyers and whatnot, because you get fixated on a payment, and now the payment's going to change on the same price house. It's a scary thought.
And I think people need to understand how low interest rates really are. And when we're in the mid to high threes, that over the last 50 years, the average for a 30-year fix has been about 8 to 8.25%. I mean, that's a significant, that rate is very, very low, obviously the lowest it's ever been. And I think new buyers don't really quite recognize how unique that is to the market. And so small changes can make a big difference once they start going up.
We're here with Ryan Leopold with Cobalt Mortgage. Ryan, we just have a couple minutes left before we have to go to break. But, so when you talk about people looking at the entire financial position, isn't that a little different too? I mean, a lot of lenders will look at the house price and the taxes and insurance, but it's not that full scope of what somebody can really do. I mean, with their debt, whether it's a car payment, whether it's a credit card, there's a lot of different ways to more effectively use your money in order to maybe even have a lower outflow of cash on a monthly basis, even with a slightly higher priced house.
And I think that's what a good lender is going to do. They're not just going to say, they're not going to be order takers, and somebody comes in saying, I'm looking to buy this house, how much I want to put as a down payment, what are my rates and payments going to be? I think that's one way to look at it. But if you want to take that next level and look at the biggest liability someone's going to get in their entire life, with, in a lot of cases, the biggest asset that people own, I think you have to look at it in a unique way and basically adjust that mortgage based around their overall financial objectives. And so that's really what I think a good lender is going to do, is look at the difference between a 30-year and a 15-year fixed. Look at the difference between 20% down and 50% down based on what else they're trying to accomplish. And I think within the options that are available, there's the right strategy for everyone's financial position.
Yeah, and but you do, as you said, the experience and the quality and the knowledge of all the different ways to strategize on a mortgage. It's not as straightforward as some people think.
Then you have to implement
it's not even as straightforward as a lot of lenders think.
It is. Once you have that strategy, too, then you have to implement it. You have to implement it in one of the toughest markets we've seen from an underwriting standpoint, also with how busy the industry is right now. To actually get somebody under contract, you got to now get the loan closed and try to have it be a great experience for a buyer. And that combination of things, I think, is a tough thing for consumers to find in lenders these days.
Well, Ryan, certainly it is a difficult situation for lenders and for borrowers when rates are going up a little bit. And it's good to know there are strategies out there for people who maybe don't like higher interest rates, which, as far as I know, nobody does. We have a great show for you for the first time. Paul Cantu is going to join us, the broker and owner at the Cantu Group Real Estate and over his 12-year career as a real estate broker, successfully helped over 800 home buyers and sellers. Paul, that's a lot of home buyers and sellers, buddy. And a good friend of ours, who I am so happy is back from her summer hiatus, is joining us. Jane Hodges, a Seattle-based business journalist who covers real estate, personal finance, and general business. She's the author of Rent vs. Own, a real estate reality check for navigating booms, busts, and bad advice, which came out earlier this year. Ladies and gentlemen, my name is Ben Brashen. You're listening to Brashenomics.